So thanks for everyone for joining us in these interesting times here in the spring of 2022. So right from the start, let me just assure everyone that I will not be citing all the woeful statistics we've been hearing too often lately. The worst stock market since, or the largest increase in mortgage rates since. About the first thing one learns about investing is the past is the past. And really all that matters is what happens tomorrow and into the future. But nevertheless, I do think it can be useful to review how recent events have led us to where we are today, as that might help us gain some insight into the future. And additionally, I also think we can keep using this basic framework that I've been using in recent months and the last few of these calls, as I still think that provides a handy way of thinking about what's happening today and into the future. As we might recall, a few months ago, we identified the critical actor as the Federal Reserve and what role they take on in the face of accelerating inflation. As I kind of phrase it, moving from a stance of benign neglect to more of a parental role. But the question we were raising was, would it be a stern parent role or kind of a more indulgent stance? And I believe that their preference was to be indulgent. And how I kind of categorize that is by orchestrating a sequence of small, predictable interest rate increases, that wouldn't really upset investors very much. And since that was the Fed's preference, I believe that was the likelier outcome. And, that would be a fairly benign one for the financial markets. However, I felt that was the more likely outcome. I did recommend taking investment positions to prepare for a less benign scenario, underweighting longer term bonds, steering clear to the extent possible of the riskiest elements in the stock market, kind of overpriced growth in technology stocks, and particularly those with a very shaky or non-existent business model. And unfortunately, as we've seen over these past few months, and as I had feared, inflation has been stickier than was anticipated. And events, particularly a homicidal maniac's invasion of Ukraine, have left the authorities really no choice but to put on the mantle of the stern parent. The surge in inflation and the Fed's anticipated response has indeed rocked the financial markets. And yes, it's true, longer term bonds and the riskier stocks have taken the worst blows. But I mean, honestly, that's a little consolation when both stocks and bonds have fallen. And really the only safe havens have been conventional energy stocks and money market funds. So although as we sit here today, the situation remains quite fluid, what is being anticipated now is a significant tightening of financial conditions, with short-term interest rates rising from where they were at the beginning of the year, which is 0, to perhaps 3% by the end of the year, as the Fed belatedly strives to fulfill the most significant responsibility they have, which is to maintain a stable, low inflation rate. So I guess the question we will try to get to is, what effect might stern parenting have from here? And in particular, as we mentioned in the email introducing this call, on bonds and stocks, and also housing. We can speculate on that as well. I just want to take maybe a half step back first and just say, to be intellectually honest, I guess we must consider the possibility that all this talk will amount to nothing, and that the negligent parenting or absentee parenting will continue to be the status quo. To our way of thinking, this is actually the scariest scenario of all. And fortunately, it seems extremely unlikely at this point. So again, what really talking about with this is really no interest rate increases, or very few, and not really doing very much at all. So kind of an negligent parenting, maybe I categorize it as. So if this happened, policy, as we talked about, would just continue to be very stimulative. And we already have an environment of shortages and low unemployment. We probably would see rampant uncontrolled inflation with pretty disastrous effects on bonds. which would also bleed into the stock market. Mortgage rates would skyrocket. That would severely dent the housing market. One thing about the housing market, though, it would probably show itself to be pretty resilient almost under any interest rate scenario. Supply is very limited now, demand is high, and demand probably wouldn't diminish much in a world in which everyone would be running around looking for inflation hedges. So just throwing that out there. But as said, the likelihood of this kind of negligent parenting is pretty low at this point. So if indeed we are in a more realistic regime of this stern parenting, again, what might happen? And again, how will this play out for investors and our portfolios? So really kind of two possible outcomes from the stern parenting scenario. The one the Fed is pointing to is the soft landing. I apologize for the cliche, but the soft landing whereby inflation is brought down without breaking the back of the economy. And even though the tightened financial conditions will remove much of the froth from the stock market, I guess we say, has most of this already been accomplished? Maybe. But overall, the scenario is quite positive as we look forward. And although short-term interest rates would rise, long-term rates or mortgage rates should be pretty stable or even decline a bit as inflation expectations recede. And this soft landing scenario is the most attractive by far for all the asset markets. Even for real estate, it's the same supply and demand conditions hold, but mortgage rates remain near their current level, which are still, quite reasonable from a historical perspective. So the other one we must talk about, the much less attractive alternative to the soft landing, is that by necessity or by accident, the financial tightening yields a recession, maybe by late 2022 or early 2023. So what I mean by this, a recession by accident would simply mean that they overreacted, that inflation was indeed more transitory than is being thought now or anticipated, and that there was no need for these kind of significant interest rate increases. A recession by necessity means that inflation remained far stickier than hoped for, and that the only way to truly tame it was to induce an economic slowdown, tamp down demand for these various commodities, and most importantly, create the conditions for an increase in unemployment, because the labor market is truly the critical one. In the end, if demand for labor exceeds supply, wages will increase at a rapid pace, and that in itself makes inflation inescapable and self-perpetuating. It truly gives me no pleasure to suggest that this is the likeliest outcome overall. As I say it, many of the trends pushing inflation higher, beyond just the commodity shock from Ukraine, higher housing costs, the retreat from globalization, the huge cost from the eventual transition to sustainable energy, those all remain, and thus inflation is going to prove quite stubborn to subdue. So more tightening than is being currently projected might well be needed to wrangle inflation lower. And what could the impacts of this be? Well, of course, in a recession, earnings take a beating, and this would be expected to hit stock prices pretty hard. The tricky part is when we ask, though, but wait, hasn't this already happened? And yes, we've seen a significant pullback. But to be honest, we could see more. But what's very tricky, I think, from my perspective, is that there's no easy way to predict, or even a hard way to predict, when the bottom will be found. And as we've seen repeatedly, when that bottom is reached, the bounce back is so rapid and explosive that not only couldn't it be timed, but the cost of missing it is so huge that we can never make back those gains that we miss out on. So stock market, pretty tenuous in a recessionary environment, but the news is better for bonds. Bonds do prosper when the economy sputters and inflationary expectations come down. So as an investor and advisor, what I take from this is that it actually warrants a bit more optimism towards bonds. And after what I consider to be a pretty prolonged period of pessimism, from the family firm and myself, and a cautious position to stocks. Again, particularly to those areas that are most vulnerable to an unexpected financial tightening and unexpected rises in interest rates. As for real estate, not to neglect that, I could see it taking a bit of a hit if unemployment really gets high and spending power diminishes. But overall, and this is really true under all these scenarios, until we find a way to increase supply of houses, the markets will be supported reasonably well. And given what's happened with builders and their ability to find labor and to find materials, it's just hard to imagine a huge increase in supply to soak up the demand. So let me wrap up, and I do, of course, really looking forward to people's questions or what you might be hearing and reading about. But I just wanted to one note just to remind our long-term financial planning clients, or even some that haven't been with us for that long, of kind of the value of the Monte Carlo process that we subject everyone to, that randomizes annual returns and thus provides a stress test to our financial plans. I mean, the Monte Carlo simulations know that markets do go down as well as up, that recessions or pandemics or other unforeseen events do occur. They're inescapable. So what I would just suggest for any of you concerned how recent events might be affecting your own financial outlook, please just give us a call, because it's really in the difficult times we're having a well-designed, comprehensive financial plan that does anticipate bad times as well as good. That's truly when the plans are, we feel that we add the most value to our clients' financial lives. So with that, and I'd love to hear what's on your mind, any questions you might have. Certainly there's been no shortage of big events over recent months. So
hello, Nate. This is Andrew Bergen.
Hi, Andrew.
I want to thank you for most clearly explaining at our last annual meeting the proportion of the market, of the stock market, that high-tech, interest-sensitive companies makes up, because I usually ask that question about high-tech companies, and I'm not sure why I hadn't picked that up before, but your point about if you're in the market, you're exposed already. So I don't know what it was about our last meeting, but it finally became clear to me. And obviously, in the current situation, your long-standing caution about going deeply into those companies obviously was the right one.
I don't ascribe to myself any particular brilliance when it comes to that, but just the way the market has become so concentrated in recent years. And again, don't quote me on these precise statistics, but I would say roughly some of this is before some of the big ups and downs that have occurred in the last week or two. But I feel safe to just say 7 companies comprising about 25% of the S&P 500. Pretty much, if not, if I just can't flat out declare this, but an unprecedented concentration of the market within just a few companies. And really those few companies, as Andrew was pointing out, considered technology companies, Apple again, Microsoft, Facebook, although that's shrunken quite a bit from where it was, and companies like that. And let's hope that the market becomes more balanced by a rising tide lifting more companies to just a handful of them, because that is kind of when we buy our S&P 500 fund, we really do want that to be more diversified than it has been.
What do you think the effects, if they continue, of the conflict may be on food prices, and how is that going to play out? I mean, some farmers will benefit, but consumers, of course, won't. For example, if wheat markets are disrupted because some large proportion of wheat is not able to get to the market.
Yeah, we'll help the exporters, and of course, gosh, the number one exporter is Russia, so it's kind of unfortunate. But yeah, it sort of creates a generalized inflation throughout the world that doesn't really benefit anyone, except as you pointed out, the share of the population that works in agriculture. And even then, they're being pummeled too, because without fertilizer, of course, the yields are terrible, and without oil, there isn't much fertilizer. So, the cost of fertilizer has gone up even faster than the cost of wheat. So even the farming sector is really finding themselves entrapped in what's going on. I guess it'll be interesting, and I don't mean this in a positive way, is what affects the nations that are huge food importers, how they will be able to control, the impacts on their own economy. So the number one wheat importer in the world is Egypt, gets it all from, not all, but most from Ukraine and Russia. And how will they cope? And how will, many of these countries are kind of are a very tenuous political situation. How will they adjust to all of a sudden a lot of their population not able to feed themselves anymore? So pretty scary times, and really it's all happened so quickly just in these past few weeks or so that it's really it's unclear what's going to happen to the less developed nations, or just the nations that are more food dependent. I guess India would be another one. What are the ramifications for this going to be? Because it's obvious that it's not just going to be resolved in a couple of weeks, and everything, all the sanctions will be taken away, and everything will be fine. So as this really settles into the long-term status quo, or that's not the right word, but kind of a new equilibrium, which is a much less favorable one than was 3 months ago. How the various players throughout the world will be able to adjust to it. It's going to be pretty daunting. It'll have to be a huge devotion of resources to food production and distribution, which are really just very unproductive in terms of the overall economy. Okay, I know Steve will probably end up explaining this better than I will, but I know, kind of our mission is to place the recording of the call up on the site, and then to, send it out to everyone. So we'd be, thrilled to do that, and look forward to doing that in the upcoming day or three. And in the meantime, as I said, if anyone has any questions about their own situations, or if I can elaborate on anything that I talked about, I'd be happy to do it.